Corporate finance presentation, public versus private financing. Get ready, it's time to take your chance with corporate finance. Private financing. Private financing is preferred by many companies wanting to remain private. It restricts financial activities to direct dealings and negotiations with institutions such as banks and insurance companies and so on. There are advantages to being public, one of the primary advantages being more access to capital funds. So if you're on exchanges, you have the ability to access capital from more people, then you have more access to the capital funds. That's one of the primary advantages of being public. Can be beneficial for bank negotiations as well. So when you're negotiating with the bank, it can be a beneficial situation to be public. Allows the use of stock as a kind of currency to purchase another company. So now that your stock is basically something that's being traded, if it's on an exchange, for example, it's more determinable about what the market price of the stock is, and it's easier then to use the stock as kind of a form of currency, given the fact that it's more like a currency in that you basically have a market price for it that can kind of be determined by the market. May issue marketable securities for the purchase of another company, so that's another option you have when you're thinking about the purchases and merging type of situations. Stockholders have a more liquid asset, can more easily diversify and plan. So in other words, when you're thinking about the owners of the corporation, the stockholders, if they have a public company, that public company being more liquid given the fact that its stock is on the exchanges, and that means they can buy and sell the stock more easily, that makes it easier for them to diversify their portfolio as well. So being public disadvantages. Now, of course, there are disadvantages to being public as well. So a company needs to think carefully about whether or not weigh the pros and cons of being public or not. So required to provide financial information to file. So obviously, if you're a private company, then much of your financial information is yours. You're not required to disclose the financial information as much than if you are a public company. The public company, you need to file with the SEC and you need to show them financial information. And of course, when you are public, part of the benefit of being public is the access to capital. Part of the cost is that you're going to have to be more kind of transparent with your information for that to be the case. Generally result in pressure to generate short-term profits, often resulting in sacrificing long-term profit, pressure from institutional investors. In other words, institutional investors might not be in it for the long haul. They might want that short-term boost, that short-term gain, and that could be costly to the long run because some of the ways that you could get the short-term gain is to do things that are detrimental to the long term, things that could harm, say, the asset of goodwill, the intangible type of assets of the company. So there's often this tension between what would be good overall in the long run for the company and what would be good in the short run to get the short run gains. So management often has an incentive to emphasize short-term profits. Management as well, because management could have the turnover, often has the pressure to show that even growth curve as well instead of looking at the long term. So we have that kind of agency problem with the management of the company as well. So it can be costly for smaller companies to go public. So if we're talking about a smaller company, just the process of going public, doing the paperwork, going through all the role to get to the point of being public can be expensive with relation to the amount of revenue being generated. So typically your revenue needs to be up to a certain level before going through the process. The cost of going public would be beneficial for it. So public offering, the issuance of shares to the public. So obviously when you're talking about a public offering, then you're talking about issuing shares to the public. Remember that you can be a corporation and not be a public corporation. When you're talking about publicly corporations, you're usually thinking about corporations that are on an exchange. In other words, the corporation is issuing to the public and having the benefit of getting capital then from the public. The issuing company needs to file registration statement with the SEC. The statement will include a prospectus having details of company offering. So one of the things you got to do if you want to get access, of course, to the capital from the public is provide this information to the SEC and be able to qualify to get on the exchanges. That's going to be part of the cost of going public. If you don't want to go public, of course, then you may not want to do that. You may say, hey, I don't want to give all my information out there, and I don't want to be going through all the hurdles that I need to do to get on the exchange and basically to file with the SEC. Well, that's fine. Then you could be private. But of course, then you don't have the access to the capital markets in the same way as a public company would be. So the idea of going public would be that you're going through some of these hurdles in order to gain confidence, so that when you do distribute to the public has confidence about, the companies that are on the exchanges and whatnot, which will increase the level of investing most likely as the confidence goes up. So we have private placement, selling securities directly to insurance companies, pension funds, and wealthy individuals can be used to avoid or defer the IPO, the initial public offering, and incorporate private funds into the financing package. The advantages: expensive registration process with the SEC is avoided, the Securities and Exchange Commission. More flexibility to negotiate than when you have in a public offering. The initial costs are lower. Disadvantages: the interest rate on bonds is usually higher to compensate the investor for holding a less liquid obligation. Going private. Now, you might be in a situation where you say, well, what if I was public and I wanted to go private? Many companies have given up public listings to be private. Why would you do that? Why would you say, it seems like the goal is to start up a company, get big, and then go public. And most people don't really understand, well, why would you even want to go public? What's the point? One of the main things, of course, about being public is that then you're going to have the access to that capital, which allows you to grow more. But possibly you might not need the capital. You might be doing fine without that added capital, and you do have the added costs, or you might be able to generate your own capital to do the growth that you want to do. And of course, when you go public, then you have the added costs that are going to be involved, including, filing with the SEC, going on the exchanges, and then having to do all the regulatory stuff, which could be increasing over time. To make sure that we do have the transparency that would be needed, so that you can then trade your stocks on basically an exchange to the public. So part of the reason was to save annual report costs and legal and auditing fees. So note, if you're a public company, all the regulations can be large, and the auditing fees are something that you have to pay for as well. Those can be quite costly. So there could be situations where you actually are public and then you want to go back to private in order to reduce some of those costs. So there's a couple methods you could do that. You might say, well, how would that be done? Because now your stock is already on the exchange. Your company's basically owned by multiple different people that own the stock. The stockholders that are now part of the public now own the company. So how would you bring it back to being private? You'd have to basically get the ownership, back down to a level where you can have them wanting to take it private, right? So we have two methods. Method one, the publicly owned company is purchased by a private company or equity fund. So the private company purchases the public company. Or method two, the repurchasing of all publicly traded shares from shareholders. So method two is basically repurchasing the shares, and that could be done possibly with a leveraged buyout. That's going to be a way that you could possibly go private, which the leveraged buyout. So leveraged buyout, the management or an investment group borrows so they can repurchase company shares. So you might have a group that's going to be coming together. You can imagine them coming together, borrowing money so that they can repurchase basically the shares. The company then has substantial debt and large interest costs. So the idea being, most likely, if you're going to go private in this way, is that you have this large company. Possibly you have a company where you're saying, hey, there's a lot of things in this company that we think are excessive. That's not where we want to put our time. Maybe you have some kind of conglomerate and they're doing a lot of different things. And you're saying, hey, look, I'd like to buy the company, trim it down, sell off all the components that I don't think are useful, and then work and move forward with the components that are. So once you get the money together to buy it out, you have taken on a lot of debt in order to do that. And then the idea is that the management of the private company then sells assets to reduce the excess debt. So you're going to take the assets then that you don't think are going to be useful. That's not where your core component will be. You'll basically sell those off that will then be used to pay down the debt that is there from the purchase. And then the corporate restructuring happens. Divisions and products are sold, and assets are shifted into new areas attempting to get the higher returns. So you can imagine possibly like a large company, like a conglomerate that's doing a bunch of different things. You're going to break it up, possibly. You're going to say, hey, look, this is where I think the focus would be. This is what I want to do with it. This is where we're going to go as a private company at this point in time. Everything else is either going to be sold or it's going to be realigned or repurposed to go to what we think is going to be the most profitable item, hopefully increasing the returns once done. We could have a breakup value in order to help with this, and this could be done by the investment bankers to help determine and go through this process. So it tries to find the value of all divisions are divided up and sold separately. In other words, when you think about the company as a whole, you might say this is a big, large company. You kind of have a valuation of it because you know what it's valued in terms of the stock price, and you have the financial statements. And then you want to say, well, what would happen if we took this company and broke it up into different divisions so that they're all doing different things? What if I broke this up on a piece-by-piece, division-by-division kind of component basis to try to think about what would happen if we had the leveraged buyout and then we decided to sell components of it or refocus some of the assets to the place that we would want to do. So we might try to value the company in that situation. And again, the investment banker might help with that process. So it may be useful in the investment buyout decisions to have this kind of breakout to be done. And you can imagine, again, the thought process that would be going into place. You'd say, okay, we're going to put the money together. We're going to take out a loan. We're going to purchase this giant company. Then we're going to basically take it private. And then we're going to pay off the loan that we had, or at least reduce the loan a lot by restructuring all the things that we don't think are going to be useful, selling them off or refocusing them into the area that we want to focus in on, and then hopefully increase our returns by being more focused on what we want to do with it.